Similar to the previous video, in this video also let us continue our discussion on classification of ratios. We know that as per functional classification, ratios can be classified as liquidity ratios, solvency ratios, activity or turnover ratios, and profitability ratios. Within this, we have already discussed liquidity ratios and solvency ratios. Now, let us discuss activity ratios in detail. These ratios are also termed as turnover ratios. Business organizations measure if the available resources of the organization are utilized judiciously and whether the organization is carrying on the business efficiently. The activity ratios or the turnover ratios help to measure the efficiency of business operations based on whether the available resources are utilized effectively. In other words, these ratios measure how efficiently the business organization are carrying on the business activity. The activity ratios that we are going to discuss are the inventory turnover ratio, trade receivables turnover ratio, trade payables turnover ratio, net assets or capital employed turnover ratio, fixed asset turnover ratio, and working capital turnover ratio. The first activity ratio that we will discuss is the inventory turnover ratio. The inventory turnover ratio measures how frequently inventory is converted to revenue during the period under consideration. It establishes a relationship between the average inventory and the cost of revenue from operations. The formula to compute the inventory turnover ratio is cost of revenue from operations divided by average inventory. Here, cost of revenue from operations means revenue from operations minus gross profit. Alternatively, the cost of revenue from operations can also be calculated as purchases plus opening inventory minus closing inventory plus direct expenses. The average inventory means opening inventory plus closing inventory divided by 2. This ratio measures the pace of utilization of inventory of an organization. It shows how many times inventory is replaced during a given period of time. A low ratio indicates that inventory is moving slowly, whereas a high ratio indicates that inventory is getting replaced fast. The next activity ratio that we will discuss is the trade receivables turnover ratio. This ratio evaluates the liquidity of receivables. It measures the relationship between credit sales and trade receivables. It shows the frequency at which trade receivables are realized. The formula to compute the trade receivable turnover ratio is net credit sales divided by average trade receivable. Here, average trade receivable means the total of opening debtors and bills receivable plus the total of closing debtors and bills receivable divided by 2. The turnover of trade receivables indicates the liquidity of an organization. A higher ratio indicates speedy collection of trade receivables, whereas a lower ratio indicates a slower collection of trade receivables. This ratio also helps to calculate the average collection period, which is calculated as number of days or months divided by the trade receivables turnover ratio. So, average collection period is equal to number of days or months divided by trade receivable turnover ratio. The third activity ratio that we will discuss is the trade payable turnover ratio. This ratio evaluates the liquidity of payables. It measures the relationship between credit purchases and trade payables. It shows the frequency at which trade payables are paid. The formula to compute the trade payable turnover ratio is net credit purchases divided by average trade payable. Here, average trade payable means the total of opening creditors and bills payable plus the total of closing creditors and bills payable divided by 2. The turnover of trade payables indicates the pattern of payment of trade payables. A higher ratio indicates a quicker payment of trade payables, whereas a lower ratio indicates a delayed payment to the creditors and suppliers. This ratio helps to calculate the average payment period, which is calculated as number of days or months in a year divided by trade payables turnover ratio. So, average payment period is equal to number of days or months divided by trade payable turnover ratio. The fourth activity ratio that we will now discuss is the net assets turnover ratio or the capital employed turnover ratio. The capital employed turnover ratio measures how efficiently an organization utilizes its funds or its resources to generate sales. It expresses the relationship between revenue from operations and capital employed or net assets. The formula to compute the net assets ratio is revenue from operations divided by capital employed. Here, capital employed means long term debts plus shareholders' funds. A higher ratio indicates a higher efficiency in utilization of resources. The efficiency of utilization of an organization's resources, assets, or any other component is measured by the turnover ratios. A higher ratios indicates a better liquidity and profitability for the business. The capital employed turnover ratio can be further analyzed in depth by calculating the fixed asset turnover ratio and the working capital turnover ratio. A further analysis of the capital employed turnover ratio can be done with the fixed asset turnover ratio. The fixed asset turnover ratio measures how efficiently an organization utilizes its fixed assets to generate sales. It expresses a relationship between revenue from operations and net fixed assets. The formula to compute the fixed asset turnover ratio is net revenue from operations divided by net fixed assets. A higher ratio in this regard indicates a higher efficiency in the utilization of fixed assets to generate sales and hence a better profitability for the business. Another further analysis of the capital employed turnover ratio can be done with the working capital turnover ratio. The working capital turnover ratio measures how efficiently an organization utilizes its working capital to generate sales. It expresses a relationship between revenue from operations and working capital. The formula to compute the working capital turnover ratio is net revenue from operations divided by working capital. Here, working capital is current assets minus current liabilities. A higher ratio in this regard indicates a higher efficiency in the utilization of working capital to generate sales and hence a better profitability for the business. With this, we have discussed all the activity ratios. We will discuss the profitability ratios in the next video.